In this video, we're going to be performing a deep dive on People's United Financial's dividend safety. To begin, let's talk about People's business model. People's United Financial is a diversified financial services company that provides commercial and retail banking and wealth management services via its network of over 400 branches in the Northeast. The company operates as a holding company that owns People's United Bank. It has total assets of $48 billion and trades with a market capitalization of approximately $6 billion. People's United Financial is a well-known dividend stock because of its compelling track record of dividend growth. With 26 years of consecutive dividend increases, People's United Financial is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors cannot rely on People's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss People's United Financial's dividend safety in the context of the company's current earnings. When People's reported fourth quarter financial results on January 17th, the company announced that it generated earnings per share of 35 cents in the 3-month reporting period. People's currently pays a quarterly dividend of 17.5 cents per share, which implies a payout ratio of exactly 50% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. People's generated $1.29 of earnings per share in fiscal 2018 and distributed 69.75 cents of common share dividends during the same time period for a dividend payout ratio of 54% in the most recent quarter. Using earnings, People's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare People's current dividend payment to its free cash flow. Note that People's 10-K was not yet filed with the U.S. Securities and Exchange Commission when this video was created, so we are relying on financial data through the first 9 months of the fiscal year in this free cash flow dividend safety analysis. Through the first 9 months of the fiscal year, People's generated $459.8 million of cash flow from operating activities. The company does not explicitly list capital expenditures on its statement of cash flows, but two line items are similar: purchases of premises and equipment for $17.3 million and purchases of leased equipment for $31.3 million. Adding these two line items together gives capital expenditures of $48.6 million. Subtracting this capital expenditures figure from People's operating cash flow gives free cash flow of $411.2 million. For context, People's distributed $178.8 million of common share dividends during the 9-month reporting period, which gives a free cash flow dividend payout ratio of 43%. Using free cash flow, our conclusion is the same as when we use earnings to measure People's dividend safety. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze People's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. People's performance during this time period is shown here. People's earnings per share declined by 54% peak to trough in the worst of the 2007 to 2009 financial crisis. More importantly, the company failed to cover its dividend payments using earnings per share. Because of this, we recommend that investors monitor the bank's performance closely during any future economic downturns. The last angle that we will use to assess People United Financial's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its net income will no longer cover its dividend payment. At the end of People's fiscal 2018, the company's non-deposit liabilities totaled $5.2 billion. Its non-deposit related interest expense totaled $104.2 million in the same fiscal year for a weighted average interest rate of just 2%. The following image shows how changes to People United Financial's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, People's United Financial's weighted average interest rate would need to rise to well above the 7% level before its dividend would no longer be covered by free cash flow. While this is not as high of a margin of safety as some of the other companies that we've performed this same stress test on, we believe that the company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on People's United Financial's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you are interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.